Well, the Fed's job keeps getting more and more difficult, and that's because we got some conflicting data this morning on the jobs market. It is Tuesday, December the 9th, and this is Markets with Megan. If you like this podcast, you can subscribe, hit the alarm bell, also share it with any of your friends, your family, your colleagues, anybody who's interested in what's going on from an economic data perspective and what it means for the markets. Let's break it down what we got this morning from the labor market perspective. We got some of the delayed government data. The JOLTS job openings report for both September and October was released this morning. When we focus on October's data, we saw that the job openings out there rose more than analysts had expected, with 7.7 million job postings for the month. It was the highest since January of this year. And that was after 2 consecutive months where we saw the number of job postings fall below the number of unemployed. Instead, in October, we got the reverse of that. We got the number of job postings exceeding those of unemployed. So that's showing a tight labor market. Again, it's 1 month data. We won't take that as a trend, but it is something the Fed's going to pay attention to. We also got the NFIB Small Business Optimum Survey, which when you look at the hiring plans in that survey, it showed that those small businesses expecting to increase hiring actually rose to the highest we've seen at all this year. So it's the highest since December of 24. Now, on the flip side of this, the negative side of these reports shows that the openings that were reported were concentrated in a couple sectors. It was retail and trade, and then healthcare. The layoffs actually rose to 1.85 million, and that was the highest we've seen since the beginning of 2023. That was primarily led by some of those discretionary sectors, accommodation and food services. So that can show some softening in consumer demand, which ultimately can show softening in the labor market. The quits rate, which is also those people that are leaving their job voluntarily. Now, this tends to rise when the labor market's very good. People will leave their job voluntarily with the expectation they can get another job. This actually fell again this month. It's the lowest we've seen since May of 2020. So that's showing that employees are more concerned about their jobs at this point and the prospects. And that echoes some of the stuff we've seen in consumer confidence reports as well. Now, from a market perspective, the equity markets are higher on this news, and that's because we're not seeing a collapse in the labor market, but the Fed it's not enough to move the needle with what the Fed will do tomorrow when they meet to set interest rate policy. So equities are slightly higher. We're still about 1% from that all-time high, but again, trying to get to that all-time high and break through that. Bond yields are relatively unchanged on this news, and we don't think it's going to change the outcome of tomorrow's meeting. The Fed will likely come in and cut interest rates by 25 basis points as expected. That's all we have today. And as I mentioned, we'll be back tomorrow to talk about that much anticipated Fed meeting, specifically around their comments and what they see for the future path of policy. Thank you. If you want a history of our podcast, you can go to marketswithmegan.fm.